Okay, welcome back, everyone, and good afternoon. Thank you for joining us for our weekly options education webinar series. Today, we're going to be talking about how to trade debit spreads, and this is really going along the how to maximize your profits by minimizing your risk using debit spreads as your strategy to take a directional view on any underlying stock or ETF. Now, I think this particular topic is quite timely considering the fact that we're just kicking off earnings season. I think there's going to be a bit of volatility coming up with corporate earnings. Volatility as a whole has picked up quite a bit. You know, technology's down almost another 1.5%, 2% today. So this is a precursor to slightly more volatile times, which is good for options traders because we're really able to capture not only that directional move, but also the uptick in volatility, and debit spreads really allow us to do that. So today we want to go through what debit spreads are, how to go about trading them, and then more importantly, making sure that we show you enough samples with some real stocks so that you are self-sufficient in being able to use our platform to price and analyze these strategies so that you can start deploying them for your portfolio. For those of you that are new, and for those of you that have experience trading the strategy, this is really designed to help make your research time as quick as possible so that you can find a debit spread to trade for any directional view within a few seconds, as opposed to spending minutes to look at different strategies and figure out what to trade. So this webinar is recorded. I'll send the recording to everyone afterwards. We're going to cover a lot of things. I don't expect everyone to remember everything, so make sure that you take a look at the recording. With the recording, I will also send out some slides, so make sure that you take a look at those slides because there's some really important links that we'll be sending out with the slides, so specifically the webinar recordings. So I'll mention a few different topics during our webinar that we've done pre-recorded webinars on. So if you want to check out any of those previously recorded topics, the link to the previous recordings are available in the slides that we send out. For those of you that are interested in our daily trade ideas and starting a subscription, you have the links right here in the Options Play links. And then most importantly, for those of you that are newer to options trading and just starting out, I highly recommend you to take a look at the Options Industry Council. It's a free resource available to everyone, and their sole job as an organization is to educate the retail or the public on trading option strategies. So everything from absolute beginner to advanced strategies is covered through the Options Industry Council. I highly recommend you to take a look at their website to learn more if you're interested in taking a look at some more resources for education. So with that, let's just jump right into what we're here to talk about here today. You know, the reason that we want to trade debit spreads is because we all have directional views on certain names in the market, whether that's individual stocks or sectors or ETFs. We all have our own views, and debit spreads really allow us to take that directional view with limited risk. It's one of the most efficient ways to take a directional view using options. And that's why we really want to spend some time going over, number one, what is a debit spread, meaning how do you construct it? When is the right opportunity to use debit spreads? This is something that I see a lot of misuse sometimes with respect to debit spreads. So it's really important for us to understand what is the optimal time to enter a debit spread. So I'll break that down for everyone. And then more importantly, how do you trade debit spreads effectively? Meaning, what type of expirations, what type of strike prices do you choose in order to decide the optimal debit spread for the given outlook you have for that stock or ETF? And then lastly, we'll cover debit spread strategy management, meaning once you're in a trade, once you've bought a debit spread, how do you manage that? How do you decide when to cut your losses? When do you take profits? Really important things in order to manage these properly. So I'll go through the different scenarios and how to handle each one. And then lastly, what we'll do is we'll end this session with a live analysis using Options Play. I have a few names of a few stocks that I think are interesting names to look at right now. We'll go through both bullish and bearish examples and show you how you can leverage that quickly using Options Play into a debit spread. So we'll go through that at the end. We're going to kick this off by saying just explaining what a debit spread is for those of you that are brand new. Debit spreads are basically two-leg strategies, so they're a complex option strategy that allow you to take either a bullish or bearish view on an underlying stock or ETF. A bullish view is what we call a bull call spread or a long call vertical, and the bearish trade that you can make is a bear put spread or a bear long put vertical. So those are the two strategies that you can deploy if you're bullish or bearish using debit spreads. So let's now go into defining what a debit spread is. I want to show you guys these two strategies, how they're constructed, so that you have a better understanding of how they're used. So before I launch right into kind of how to build a debit spread, I just have a quick poll here for everyone in the room. Have you traded debit spreads before? Yes, no, or if you've never traded options before, just to get a feel for the audience here in the room. So clearly the vast majority of you have traded debit spreads, but there's still, about almost a third of you that either have only traded other option strategies or have never traded options before, which is great. So for those of you, the 70% of you that have traded debit spreads, this is really designed to help solidify your understanding of these strategies and helping you find these strategies as efficiently, as quickly as possible so that the time it takes for you to research them is shaved down to a few seconds. And then for those of you that have never traded debit spreads before, this is meant to, number one, educate you on why debit spreads are a good strategy to take if you have a directional view. And then more importantly, hopefully inspire you to consider taking a look at this strategy because, again, it is one of the most efficient ways to take a directional view for a stock while limiting your risk. And that's really why this is one of our favorite strategies to trade here at Options Play. So I'm going to start off by talking about what is a debit spread, and I'll talk through this with the construction of a fictitious stock XYZ trading at $100. I usually don't like using these types of examples because it's not tangible for a lot of people, but from a construction perspective, it is very useful to use round numbers. So I'm going to use these X stock XYZ as for helping you construct it, and then everything else we're going to move to more tangible stocks, actual stocks that you guys will trade to make this a little bit more easy to understand. So we'll talk about the bull call spread first, so the bull call vertical or long call vertical. This is stocks XYZ trading at $100. So let's say you're bullish on stock XYZ. You think it's going to go up to 105 or 110 or 125. You think the stock's going to rise. If you're only buying stocks, you would simply buy this. If you were trading stocks, you would only typically buy the stock. With the option, you have a lot of different ways that you can trade this. So to buy a debit spread, what that means is you're buying and selling an option at the same time. What you're going to start off with is you're going to buy an at-the-money call as a starting point, so a 100 strike call. And let's say that costs you $4. And this is what you would traditionally do if you were just buying a single leg option. Is you buy a call option, whatever the cost is, that's the cost of the strategy. Now, because buying an at-the-money call costs $4, what we're saying that you can do to help mitigate some risk, and there's some additional benefits that I'll go through in a few minutes, is that you can sell a higher call, a 110 call. Let's say you collect $1 for that. What that means now is that your max risk now, instead of $4 when you just bought the call, is now only $3 when you trade the spread. So you're reducing not only the cost, but also the max risk that you take on a trade. And what that also does is it actually increases the max reward on that trade, because you're trading a 100 call and you're selling a 110 call, the width or the distance between those two strikes is $10. So your max reward is always going to be the distance between the two strikes minus the premium that you've paid. So if you pay $3 for the spread, your max reward is going to be the remaining $7 in that $10 width spread. And what this does is it gives you upside exposure on stock XYZ as long as it continues to go higher, but it's capped at a certain point. So anything above 110, you're not going to be able to make an additional profit on that. And we'll talk a little bit about why you want to cap your risk in a few minutes, but we'll come back to that when we get to some real examples. Next, I want to look at a bear put vertical. So this is if you're bearish on stock XYZ that's trading at $100. Maybe you think it's going to fall back down to 90 or 85. If you were a stock trader, you would have to short the stock, which does require certain things like margin accounts to do that. You need to be able to borrow the stock from your broker. There's quite a bit of requirements that comes with shorting a stock. With a put option or a put spread, it's just as the same as buying a call or a put. You don't have to short anything. What you do is you start off by buying a $100 put. Let's say that costs you $4. This is very similar to a basic put strategy. where you're bearish on a stock, so you just simply buy a put. But now with the debit spread, what we're going to do is we're going to sell a lower put against that. So now we're going to sell, let's say, a $90 put, and let's say we collect $1 for that. So instead of paying $4 for the at the money put, we're now only paying $3 for the spread, which reduces, again, my max risk from $4 down to $3. And that's really one of the biggest benefits to trading debit spreads, is really reducing your cost and reducing your max risk on a trade. And same thing here, because the distance between the two strikes, between the $100 put and a $90 put, is $10, and we're paying $3 for that spread, the remaining distance between that width, which is $7, is going to be your max reward. So one thing that you might notice right off the bat with these types of strategies is that you're typically risking significantly less money than the potential reward you can make if you are correct on that directional strategy. And that is one of the key reasons why debit spreads is one of the most efficient ways to take a directional view in an underlying stock. So now that we talked a little bit about the construction of debit spreads, why do you actually trade debit spreads, or when do you want to trade debit spreads? The goal here is to simply profit from a large directional move in one direction or another, meaning you must first have a directional view on the underlying stock. So if we're talking about stocks XYZ trading at $100, you must think that either it's going to go up to 110 or you think it's going to go down to 90. So making a significant move is what you're going to utilize these debit spreads for. So talking a little bit about the strategy, and this is breaking down kind of why and when you should use these types of strategies and how you should use these strategies. So number one, generally speaking, debit spreads is used more so on individual stocks than they are on ETFs and indices. And the reason for this is because individual stocks tend to have larger percentage moves. ETF and indices tend not to have large gaps or large moves because they are a consolidation of multiple names, not just a single name. So they tend to be less volatile. They certainly don't tend to move as fast or as quickly as individual stocks. So that's why debit spreads is generally better for individual stocks than indices or ETFs. Next, for expiration dates, when you're picking expiration dates for debit spreads, you generally want to pick expiries that are at least 5 to 8 weeks from expiration, meaning you want to trade longer dated options because longer dated options will minimize time decay. So for those of you that are familiar with long options having time decay, in order to mitigate that, one of the best ways to do that is to trade longer dated options. And by doing 5 to 8 week options, you're going to be able to have significantly less theta or time decay than if you buy a 2-week option or a 3-week option. And lastly, when we're talking about strikes, you always want to buy a slightly in the money strike as a starting point, and then you want to sell an out of the money strike against that in order to construct your debit spread. So those are just some of the key points to think about when you're trading debit spreads, is how to pick your expiration strike prices and what type of instrument it's generally suited, it's best suited for, which is stocks versus ETFs or indices. Next, what I want to cover is really understanding the relationship between risk reward and probability, because that's going to help you set up your whole mindset behind trading debit spreads. Like many different option strategies, or all option strategies rather, there's a trade-off or a relationship between probability and risk to reward. And it's really important to understand that these two are opposite ends of the spectrum, like a seesaw. And if you have very high probability, you're going to have low risk reward, or vice versa. If you have low probability, you're going to have high risk reward. So I want to make sure that we understand kind of when you're picking your strikes, you're looking at those probabilities, you understand the trade-off between the two. So a lot of times I hear from traders when they set up a debit spread, they come to me and they say, why would you ever trade this? It has a probability of profit of 30% or 40%. And they think that because the probability is below 50, that's bad. And I want to make sure that everyone understands what the trade-off behind low probability is. So when you're trading a debit spread that's near the money, like the examples that I showed you before, where you're buying a slightly in the money option and then selling a out of the money option, what you typically are going to see is probabilities that look something like this: 33% winners, 33% probability of success. And a lot of people will come to me and say, hey, that looks really bad. Why would I ever trade anything that has only a 33% chance of winning? And I always tell them, look at the other side of the coin. Look at the risk to reward. How much money do you actually get paid when you are right? Let's just say you're right only a third of the time, but when you're right that third of the time, how much money are you making versus how much money are you risking? That's really what you want to pay attention to. So when you see strategies that have 33%, 40% probability, you're generally going to see risk reward that looks like this, where you're risking about $200 to try to make roughly $500. So about a 2-to-1 risk reward ratio. And this is really the trade-off that you get with low probabilities. You get paid when you are correct. And it's an important thing to understand. There are plenty of other strategies where maybe you could buy a far out of the money option. This is where you're buying an out of the money option and selling even a further out of the money option. This is where your risk reward looks even worse. You might only get 15% probability of profit, but the trade-off there is you're going to get even higher risk reward. So you're going to have low chance of success, but when you are right, you get paid for it. And that's really the thing that you want to pay attention to in options, is not necessarily what the risk reward is or what the probability is, but how well balanced that is. So many of you that trade credit spreads that have 80% probability, 90% probability, sure, that might sound very good, but that 10% of the time that you're wrong, you're going to risk substantially more money than all the money that you collect on the first 4 or 5 trades. You might lose all the money that you made on 4 or 5 trades on a single trade when you're trading those high probability setups. So it's not like high probability or low probability is good or bad. It's just a matter of understanding the relationship so that you understand how well balanced the two is. So based on all of those things that we talked about, you can choose all different strike price, all different expiration dates. What is the optimal debit spread then? And this is based on a ton of back testing that we've done, buying different deltas, selling different deltas, trying out different expiration dates and things like that. And what we have found is that the general optimal debit spread is always buying a slightly in the money call, so a 50 to 60 delta call, so slightly in the money call on the long leg, and then selling a roughly a 10 to 15 delta call against that. And the reason for this really is because when you're buying a 50 to 60 delta call, you're buying something that has some intrinsic value, so that not all of the premium that you're paying is extrinsic value, which means that time decay is going to be a bigger factor against you. So you want to minimize time decay in the long leg, and the way to do that is by buying an in-the-money call. And then the reason we sell a 10 to 15 delta call against that is because we want to sell a call that, number one, brings in enough premium to offset the cost of the long call, but we also don't want to cap our profits too early. That's why we look at 10 to 15 delta, meaning there's only a 10 to 15% chance the stock will hit that price or go higher above that price. So we want to find the right balance between a strike that's high enough, that doesn't cap our gains too much, but at the same token brings in enough premium to offset a significant portion of the long leg. So what we find is that when you use these types of deltas, 50 to 60 delta, and sell a 10 to 15 delta against that, the premium of the short leg will usually offset anywhere from 10 to 20% of the premium of the long leg. So if you buy a long trade, a long option for about $1, let's say, on the 50 to 60 delta call, the 10 to 15 delta call that you sell should roughly bring in 10 to 20 cents to offset that $1 that you pay. And with these types of strikes, and what you're generally going to see is higher probability of profits. Usually 33-40% is usually the range that you'll see. And then you'll have risk reward ratios where you're risking roughly about $100 to make roughly double that, $200. So that's the type of debit spreads that you should expect to trade when you're following these types of parameters to select your debit spread. And lastly, when we're talking about debit spreads, we really want to compare them to buying a call, or just straight up buying a call, because that's usually the strategy that most of you, if you've never traded a debit spread before, you're probably more familiar with buying a call. Is the reason we want to take debit spreads is, number one, you want to lower your risk, because by selling that short leg, you're going to reduce the cost of your trade, which reduces your max risk. And because you've reduced the cost of the trade, your break-even price on the strategy is also better compared to just outright buying a call. And lastly, because you're short one leg, it offsets some of that time decay of that long leg. So even though you're buying an in-the-money call, you still have time decay. And in order to mitigate that time decay, we're going to be short selling an option, and that offsets the time decay of the whole strategy. And the reason that it's so important to limit time decay is because that's one of the biggest factors working against us when we're trading options, is time decay. And the more we can minimize time decay, the more we're able to be in a trade or be exposed to a stock longer, which gives us the more opportunity to potentially make profits if we are right on that direction. But at the same time, if we're wrong, we're limiting our risk. And that's really the key to maximizing your profits with debit spreads, is this concept of lowering risk and allowing you to stay in a trade for longer so that you have a higher chance of making money on that trade. So when should you use debit spreads? Now that we've talked about how to construct them, we've talked about the benefits of debit spreads, when should you actually trade them? Because it's not something that you should be entering all the time. There's actually only very specific times that you should be entering a debit spread. Number one, it's only used if you expect a large bullish or bearish move on an underlying stock. So this is really useful if you've identified a breakout or breakdown. So if a stock is starting to break out and you think it's going to continue moving higher, or vice versa, if it's starting to break below some support levels and you're concerned that this stock may start falling apart, these types of breakdowns, these are the types of trades that you want to look for on a debit spread. Another type of trade that you might set up a debit spread for is the trading that we do when we're setting out the daily plays. Many of you follow our daily trading ideas. This is really where we're looking at a top-down approach, where we're looking at the market is lining up with the sector and the relative strength is lining up with the trend of that stock. All the things that can potentially work in our favor are lining up. These are the types of trades that you can use debit spreads for, because what you get is a higher probability momentum move that really allows you to capture that using debit spreads. And lastly, when should you not use debit spreads is really important. Is you should never use a debit spread when you're expecting a modest move. So if you're thinking a stock might move a couple of percentage points because maybe it's bounced off a support level and it's not going to continue going any lower, but you're not really sure how far it's going to go, that's not when you want to use a debit spread. You certainly don't want to use debit spreads just because in a news announcements came out, because a news announcement generally doesn't necessarily mean that there's going to be a significant move coming up in a short amount of time. And that's really when you want to make sure that you use debit spreads. Now what I really want to do is I want to just also at the same time launch a quick poll here. How do you generate your trade ideas? Meaning, do you use technical analysis, fundamental analysis, or do you use other forms of analysis? Just to get a feel for how you guys generate your trading ideas. So looks like numbers are very similar to the other one. About 2/3 of you use technical analysis, which is great, because the reason I like using technical analysis because it provides not only you with the signal, but also provides the direction, the magnitude, as well as, generally speaking, some form of timing, which is really critical because those are the three things that you need in order to find the optimal option strategy: is magnitude, direction, and timing. About 13% of you say use fundamental analysis, and 18% of you say other forms of analysis. So the vast majority of you do use technical analysis. As you can see here, 69%. But quite a few of you use other forms of analysis. So if you use other forms of analysis, you certainly still can use debit spreads, but make sure that you understand that debit spreads are only used for when you're expecting a fairly modest or directional move in a relatively short amount of time. That is, generally speaking, when you're going to get the best usage of your debit spread. So again, just to reiterate, if you're bullish on a stock, you want to buy a call debit spread or a long call vertical. If you're bearish on a trade, you want to buy a put debit spread or a long put vertical. So I just want to illustrate for those of you that are technical traders when it's a good time to buy debit spreads, when it's not a good time to buy debit spreads. So first of all, as you can see, I have a stock here. It's trading within a triangle. It's trading within a pretty big range and then starts trading in a smaller range and finally breaks out of this triangle. These are the types of trades that you typically want to enter a debit spread for because it allows you to take a directional view on an underlying stock. Potentially, you may even have a target price, so perhaps the previous high is your target price. So not only do you get a sense of direction, you get a sense of magnitude, you also get a pretty good sense of how much time it would take because charts are the x-axis of a chart is the time. So you also get a feel for roughly how long it would take for the stock to move that amount of magnitude because you have historical price movements to give you somewhat of a template. You can say, oh, this stock moved from about 96 to about 100 over the course of about a month. So roughly to go from 99 to 103, you could say a month and a half. It gives you some sense of direction and timing, versus if you're a fundamental trader, you really don't have a sense for time, right? You can feel that a company is overvalued or undervalued, but that doesn't give you an idea as far as, will it take a month to get to full valuation, or is it going to take a year to get there? There's really no sense of that, and that's really some of the power of technical analysis for those of you that are not using it. You may want to take a look at learning a little bit about technical analysis because it really helps set up, magnitude, timing, and direction. So what I want to show you here on the other side is this stock, makes a big breakout, comes back down, and then just starts trading within a tight range. This is an example of where you should not be using debit spreads. For those of you that have traded other strategies or are familiar with credit spreads, this is really where you want to utilize credit spreads instead, because you don't have a large directional move. If anything, you just feel that the stock's near its support level and maybe it'll go back to the resistance level, but you don't have a sure sense of that. You just feel that it's not going to continue going any lower when it reaches 101, and you don't think it's going to go any higher when it reaches 103. These are optimal for credit spreads. And notice that on debit spreads, I only really have one opportunity here in this whole chart to trade a debit spread versus I have multiple opportunities to trade credit spreads. That's another characteristic of the difference between trading debit spreads versus credit spreads, is that debit spreads, you're typically finding one or a few opportunities on lots of different stocks all the time, versus credit spreads, you might end up finding multiple opportunities on the same stock over and over again. So keep in mind that those are the two different mentalities of trading debit versus credit spreads. A lot of people like to compare the two strategies, but I really, in my opinion, see absolutely no comparison between the two because they're completely different strategies meant for completely different scenarios. And it's really important to understand when you should utilize debit spreads, when you should utilize credit spreads, so that you can maximize your profits using these strategies. So lastly, what I wanted to cover is just really once you're in a credit spread, a debit spread, how do you manage them effectively? And the key here really is risk management. Just like any other form of trading, if you can manage your risk, you have a better chance of being successful at trading. So we've talked about entering strategies. You want to time your debit spread when you're expecting a large move in the underlying stock. But once you're in that debit spread, how do you manage it? This is where debit spreads is fairly easy, because no matter what type of debit spread you buy, whether you buy high probability, low probability, doesn't matter whether it costs $1 to get in that trade or $1,000 to get into that debit spread. The rules are the same for managing debit spreads, and that's what makes it simple for me. Because the simpler the rules are, the more likely you're going to stick to it, and the less likely emotions are going to come into play. So number one, when you're trading debit spreads, you want to cut your losses if the move that you're expecting does not materialize. Meaning, when we're trading here and when we're expecting a breakout, if the breakout starts to move and then just kind of moves sideways and doesn't really happen, get out, because what your initial expectation of the stock really taking off, if it doesn't happen, you need to cut your losses if the move that you're expecting does not materialize. Second of all, debit spreads is really generally a strategy where you want to exit before expiration. Debit spreads is not a strategy that you typically want to hold to expiration. Just like when you buy a call or a put, you generally don't hold those strategies to expiration. Same thing with the debit spread. So how do you decide when to exit a trade? Number one, if you hit your target price, you should always get out of a trade. So if you have a target price, you think the stock's going to go from 99 to 103. Once it hits your target price, you should get out. You should not stay in a trade after it hits your target price. But if it doesn't quite hit your target price, how do you know when it's time to cut your losses? This is where the rule of thumb here for debit spreads is pretty straightforward. You want to cut your losses if you lost 50% of the trade on your debit spread, and you want to take profits if you gained at least 75 to 100% gain on your trade. So that means if you buy a debit spread for $1 and it's trading at 50 cents or now, it's about time to cut your losses. And if you bought that same debit spread for $1 and now it's trading at $1.75 or $2, that's when you want to start taking profits, or at least partial profits. So if, let's say, you're trading 10, 20 contracts, you can take maybe 5 or 10 contracts off when you've hit this target profit, and then maybe keep the rest of the position on. But if you're only trading 1 or 2 contracts, I usually recommend take the full profit at these types of levels, you don't necessarily need to continue hanging on to if you're only trading a small number of contracts. So lastly, what I want to do now is I want to go through options play and show you some real examples of stocks. And more importantly, what I want to do is show you how easy it is to use options play to find these types of strategies very quickly. Sorry about that. Let me just log in. I want to show you how quickly how easy it is for you to type in a stock and quickly look at some strategies immediately for long call, long put, and some debit spreads to really help compare the two so that you can quickly see how I find these strategies and so that you can ultimately see how you can find these strategies yourself as quickly as possible as well. So I'm going to bring up AT&T. I'm bringing up this stock because this is a stock that I talked about on one of the earnings webinars last week. This is a telecommunication stock, which is certainly a relatively weaker sector, one of the weakest sectors right now. It really kind of broke down over the last few weeks, came back up a little, and I think these are types of opportunities when you get these rallies after a big downfall. These are sometimes opportunities to get short. Now, keep in mind that this is just my personal opinion. This is by no means a solicitation to trade these strategies. This is simply, I'm creating these for educational purposes, but I do think this is an interesting trade. Recently had this topping formation, sold off significantly in that sell-off last week, rallied back a little, and I think that there's quite a bit of downside or room for this stock to move to the downside. I think 31.50 is a conservative target, but I think $30 is a more aggressive target to the downside. And it has earnings in 5 days, so that could very well be the catalyst that it needs to kind of make that quick move down lower. So let's take a look at these strategies. So for those of you that are brand new to options play, welcome. The platform itself is divided into 3 sections. We have trade ideas and watch list here on the left. We have our security analysis panel here in the middle, and then we have trading and income here on the right. For those of you that have not seen options play before, I highly recommend you to sign up for a free trial at optionsplay.com. I'll include a link in the slides at the end. But this tool allows you to type in any stock and either hit I'm bullish or I'm bearish here to be presented with 3 strategies that make sense for your given outlook on the underlying stock. So here for AT&T, I'm going to select I'm bearish because I think that there's some opportunities for this stock to move lower. You can disagree and hit on I'm bullish and be presented with 3 bullish strategies. We'll look at another stock later with some bullish strategies. But right now, let's take a look at if I'm bearish on AT&T, what can I do? So if you're a stock trader, you'd have to short the stock. That's the only way you can make money if you think the stock's going to go lower. Not necessarily a strategy that everyone has the ability to do so. However, if you trade options, a simple strategy to do is simply just buying a put option. So put option here costs $124 versus you'd have to put up probably $1,500 just to short 100 shares of this stock. Not to mention you have to pay margin interest and you have to borrow the stock. Not necessarily always easy things to do, but you can always buy a put option very easily. It only costs you $124. Or you can buy this put vertical. This is the debit spread that we're talking about. And so instead of just buying a $33 put, which is the slightly in the money put that we talked about, we're going to buy a 33 put, and at the same time, we're going to sell a 30 put against that. And what that does is it brings the total cost basis from 124 down to 102. So you're reducing, again, the cost of this trade by roughly 20%. That's what we're looking to bring in, is roughly 20% of the premium of the long leg. We're going to offset the cost of that long leg. So now instead of risking 124 per contract, we're only risking 102. And let's actually see how that affects the strategy. So AT&T is at 32.5. I said that conservatively, I think it can go to 31.5. So let's say I think it's going to go to 31.5. How do these strategies perform? If I had shorted the stock, I make roughly 3%. If I bought the put option, I make a 20% return. If I bought this put spread, I make a 47% return. So more than double what I make just by buying the outright put. So just by saving that 20% of the cost of buying that put, I've almost doubled my return on that put spread. And that's really, again, why put spreads are one of the most efficient ways for you to take a directional move. And we're not talking about a big move here. We're only talking about $1 lower on AT&T. This stock moved, $2 lower in the matter of 2 days over the last week or so. So moving a dollar lower over the next 45 days or so, November 30th, is, in my opinion, a fairly conservative outlook if you're bearish on this stock. I think for those of you that are a bit more aggressive, I think $30 or $30.50 is an easy target to the downside, especially with earnings coming up. That could be a catalyst for a big move to the downside. Look at the difference now. If you had shorted the stock, you make a 5% return. If you bought the put option here, you do make a nice 101% return, but notice here on the spread, 145% return. So that 20% reduction in cost by buying a spread versus a put is going to pay a lot of dividends if you're correct on the trade. But more importantly, to be a successful trader, you can't just think about the upside. You must think about what happens if I'm wrong. AT&T has earnings coming up. It could maybe blow out earnings and do really well. Maybe they've done some promotions this month that have really kicked off sales and revenues are going to skyrocket. And let's say the stock goes back up to $34, $35. Who knows where it can go? As you can see here, the key here about trading these strategies is not about maximizing return, but more importantly, minimizing risk, because that's how you're going to make the highest amount of profits or make the best use of your money is by minimizing risk. So here, if I shorted the stock, I lose $260 if this blows out earnings and moves to $35. I lose $124 if I bought the put option, but I only lose $102 if I bought the put spread. So not only do I get the highest return if I'm right by buying this put spread, but more importantly, if I'm wrong, I lose the least amount of money. That's how you're going to be able to maximize your profits. You know, everyone talks about maximizing profits while minimizing gains or minimizing losses. How do you actually go about doing that? You actually go about doing that just by minimizing risk. If you can minimize risk, you're going to be maximizing your profits, as you can see here in the example that I gave. And that's why this strategy here on the right has the highest options play score. Many people ask us, how do we derive that options play score? It's really looking at the risk reward and the payoff of this strategy and saying, how much do you get rewarded if you're right? How much money do you risk if you're wrong? And weight the two by each other, and then allows you to compare other strategies side by side and say which one gives you the best risk to reward. And we clearly see the strategy here on the right gives you that best risk reward, because when you're right, you're going to get the higher return. When you're wrong, you lose the least amount of money, and that's why we get the highest score. And once you're ready to trade that button, once you're ready to trade that strategy, you can hit the trade button. And what we do is we present the strategy to you in plain English, spelling it out for you as to how to enter this trade into your broker's platform. And we even have what's called a strategy checklist. This is for those of you that said you've never traded a debit spread before, or maybe you've never traded options before. Making sure that you check the strategy checklist is important so that you understand what your risks are, what to look out for before you get into a trade. Are you trading with the trend of the stock? Are you trading with the trend of the market? How's the options play score of the trade that you're making, meaning how's the risk to reward? Is there earnings between now and expiration? Something that we see a lot of beginners tend to overlook is there earnings coming up? And lastly, spread and liquidity. How liquid is this option? So we look for all of these things and score them for you, and everything is color-coded so that you can see what's good, what's bad. So if you see a bunch of green, that means, hey, everything's looking pretty good. If you see red across the board, that's just saying, hey, pay attention. Make sure you understand the risks that you're taking. Just because there's red doesn't mean you can't trade it. It just means that you should be aware of these risks before you go ahead and place that trade. So this is telling me the spread on the bid-ask is relatively large. So spread and liquidity is certainly a factor that I want to consider. So as an experienced trader, I know how to deal with this. If you're new, you want to learn a bit more about understanding how bid-ask spreads affect your trading before you jump right into it. This is just making you aware of those risks. And then once you enter that trade into your broker's platform, you can send that off for execution. So that's just a very quick overview of how you can use our platform to type in a symbol, do some underlying research, click on I'm bullish or I'm bearish, and then use the P&L simulator to compare 3 different strategies and see why many times the debit spread is going to give you that best risk to reward ratio. So what I'm going to do now is I'm just going to go through a few more examples because I want to solidify this experience for everyone. I want to look at some stocks, give you some scenarios so that you can quickly see how we leverage this platform to find the strategies that we show you in our daily play. So I'm looking at Phillips 66, and the reason I pulled this up is I actually want to play a contrarian view. A lot of times on our webinars, we go with the trend, but a lot of you, tend to be contrarian. You like to go against the grain or go counter trend. So I want to show you some different ideas, right? So Phillips 66 sold off heavily over the last few weeks. Maybe you think that this is a little oversold, or maybe you think it's a little overdone and it's trading around that 109, 110 support level, and maybe you think it's going to go back higher. Especially with some of the geopolitical risks, and you think that maybe there's a chance that oil prices could shoot up on any type of geopolitical risk over in the Middle East. What if the stock goes back up to 120, 125? I think that's fairly possible on any jump in oil prices. So let's say in this particular case, I'm going to click on I'm bullish. Now let's take a look at 3 bullish strategies. If you were a stock trader, you buy 100 shares of that stock. If you're a simple option trader, you buy a call option, or you can buy the spread, the debit spread that we're talking about here. So here it costs you $11,000 versus $380 to buy the call versus only $325 to buy this call spread. Again, reducing your cost by roughly 15% here, $380 versus $325. Let's see what the impact of that is. So we talked about this stock maybe going back up to the previous high, which is around 118, 119. So let's say we think it's going to go to 119. Here, as you can see, if I bought the stock, a 7.3% return, which is pretty good in 45 days. But if you bought the call option, you make 163% return on your money versus the spread, 207% return. So an additional 40% gain on your trade, while, keep in mind, minimizing your risk to the downside, because hey, this stock did take a beating. It's trading just a little bit below support level. There's a possibility that maybe it goes back down to 103. I'm just saying that that's a possibility. I'm not saying that's where I think it's going to go. But if it went down to 103, even a modest move down to 103, which is only $6 below where it is right now, you're going to lose $782 if you bought the stock. If you bought the call option, you lose half of that, $380. If you bought the puts, the call debit spread or the long call vertical, you only risk $325. So again, that's why the strategy here on the right gives you the highest options play score. This allows you to take that directional view so that when you're right, you get paid for it. You get paid very well, because here you're risking $325 to make $675 if you're correct on this trade. This is really where I'm talking about the low probability of profit. A lot of people complain that debit spreads have low probability of profit, but the trade-off is you're going to get paid if you're correct. And if you're wrong, you're risking a relatively small amount of money compared to what you can potentially make on the trade. So that's why I always use debit spreads for my directional views, because it really gives me one of the most efficient ways to take that directional view while minimizing my risk. And lastly, I just have a minute for one last example. F5 Networks, this is a technology stock. As we know, technology is really taking a beating. This stock has sold off well ahead of that sell-off we had last week, which is why this leads me to believe this is maybe a bit of a weaker stock here compared to some of the other technology names. Sold off significantly from roughly 200 down to 168. It's really come back a little above this support level around 170 or 168, 170. But I think that what I'm really interested in is I think this stock is going to continue moving lower. The trends have turned bearish. I think it could easily go back lower, maybe down to even 155, this prior support level. I see quite a bit of a vacuum from about 168 down to 155. So let's take a look at that. Let's say what happens if this stock goes down to 155. The reason here this stock here is showing a $7,000 loss is because for some reason after hours, as you can see, the stock has a $100 bid-ask spread. I've actually never seen that, but that's why the stock number is incorrect, is because the bid-ask spreads are way out of whack on the stock after hours. But as you can see, if I bought a put option, it would cost me $790. If I bought this put spread, only $655. So here, if I bought the stock or shorted the stock, I'd make from 169 to 155. That's about a $15 move. I make about $1,500. Or a little under 10% on this particular trade. If I bought a put option, I make an 89% return. If I bought the put spread, I make 129% return. So that's really where this put spread, again, by minimizing my costs, is going to amplify my returns when I'm right on this trade. And then just in case I'm wrong, which is always possible, and I always keep that in the back of my head, if I'm wrong, if this stock goes back up to 200, where it was before the sell-off, here, if I'd shorted the stock, again, you're not actually losing $13,000, but you're losing roughly $3,000 on this particular trade if you had bought 100 shares, if you had shorted 100 shares of this stock, versus only a $790 loss if you had bought the put. So less than a third of the risk of shorting the stock. And then if you bought the put vertical, $655, so about a fifth of the risk of shorting that stock. So that's really where, especially if you're bearish, I almost never ever recommend for someone to go short that stock, especially when you have the ability to buy a put spread that gives you that directional view with limited risk. That's how you're going to be able to maximize your profits. You know, we all have different views in the market, whether it's views triggered based on technical analysis or news or fundamentals, whatever that is, whatever your directional view is, whether that's on a stock, an ETF, an index. Using that debit spread is one of the most efficient ways for you to take that directional view while minimizing your risk. And that's how you're going to be able to maximize your profits from trading. So with that, that concludes what I wanted to show you guys here today. Again, just to remind everyone, this webinar is recorded, and I will send out the email with the slides so that you can check out some of the useful links that we've included. And for those of you that have never seen Options Play before, please sign up for Options at optionsplay.com for a free trial, and you'll be able to see the platform that we're showing you here today. So with that, what I'm going to do is I'm going to open this up for Q&A. If you have any questions, please type them into the chat window, and I'll answer as many questions as I have time for. Looks like there's a few questions already there. Lee says the more you learn, the better. Absolutely. I think everything is about education here, so I hope you guys find this useful in helping you understand these strategies and helping you find the strategies that you should be trading or using these strategies to trade those directional views that you have. Where would you generally place a stop loss? Great question. So that's where we covered this already, I believe. I don't know if that question came in before we covered this. You want to cut your losses at 50% losses. So if you buy an option for or a debit spread for $1, you want to cut your losses if you lose about 50 cents on that trade. If I expect a slow move in the stock, what strategy should I be using? You should be using credit spreads. So we talked about if you're expecting a slow, modest move in an underlying stock, use a credit spread. And if you want to learn more about that, make sure that you check out our links in our webinar recordings. We have one specifically on how to trade credit spreads. And actually, that's a topic we're going to do next week. I actually have a really big announcement next week. We're going to be launching a new trading strategy for credit spreads. I know a lot of you trade credit spreads, so we're going to be announcing a new strategy next week to allow you to follow new credit spread ideas. So make sure that you register for that webinar next week if you do trade credit spreads or want to learn about that. What percentage or dollar move would you consider to be a large breakout? I usually say at least a 3 to 4% move over a 1 month period is what I would consider a decent sized breakout. But that's the thing is sometimes you don't need to know, you don't have to figure that out. You can use our P&L simulator to say how big of a move does it need to do in order for it to be worth my while. So AT&T is at 32.50. We're looking at this spread. You can use our P&L simulator to say, at what point am I going to get enough return from my vertical spread in order for it to be really worth my while to take a look at? So let's say you want to get at least a 75% return, right? So here it'll tell you the stock needs to move down to $31.11 for that to happen. So you can say, okay, that's about $1.50 downwards. So you can ask yourself, do I think AT&T is going to go down to $31.11? If you do, then you can work backwards from that. So you don't always have to know where you think the stock's going to go. You can set up a strategy and work backwards using the P&L simulator and then say, well, do I think the stock's going to go down to $30.41? If I do, great, I'm going to get 153% return. If I don't, then maybe this is not a strategy that I want to trade. Great question. Aside from the 50-10 delta range you discussed, is there a percentage of fair value of the cost of the debit, i.e. based on the dollar spread, i.e. if the spread that's $5 wide, should the cost be at least X dollars? Yes. So similar to credit spreads where you generally have some kind of a relationship between the max risk to max reward, that's exactly what we discussed here in this slide, actually. Let me just go to it real quick. What we find is the optimal debit spread will roughly give you about a 2-to-1 risk to reward ratio. So in your case, if the spread is the width is $5, you want to look for about $1.33 by $2.67, which gives you that 1 to 2 risk to reward ratio. So yes, you can think of it in terms of the distance of the width between how much money you make versus how much money you're risking. I hope that answered your question, Jay. Please try Whirlpool with earnings on October 24th. I'll try to come back to that. I don't have a lot of time to go through some real examples here, but I'll do this real quick. Whirlpool has earnings on October 24th. I don't know if you're bullish or bearish on this particular trade, but let's be contrarian here. Let's say you think this is bottom and you think this got some potential to move higher on earnings. So let's say you think it's going to move higher. Here you can buy the 100 shares of the stock, 10,000 versus 745 versus 647. But let's say you think the stock's going to go back up to 123, 124. Here, you can quickly look at 13% gain on the stock, 128% gain on the call, 147% gain on the call vertical, versus what happens if the stock stays where it is. What happens if it stays at 102? Here, as you can see, the three look roughly the same. And whenever the three strategies look roughly the same, I always go for the one that has the least amount of risk because, hey, you never know what's going to happen. I'm always going to try to minimize my risk, especially when the upside's there. I'm going to always pick the one with the least amount of risk. Jay's asking with F5 networks, it's got a score of 7, 1 month and 6 month trends are bearish. How come? Jay, I really think you should take a look at one of our webinars on directional edge or directional views, because this means that this is a relatively strong stock that has recently started to turn lower. As you can see, that just happened on October 4th. It just started to turn bearish on October 4th. So this is the start of a potentially a much larger bearish trend. And this is really how you can identify some of these starts of bearish trends, the stocks that have high relative strength but started to turn bearish. This could be the start of a much larger trend lower. And using these two indicators alone, that gives you an idea as far as not only what the current trend is, but how long it's been in that trend for. Bill's asking, why don't you accept the recommended options play spread? Isn't that the highest rate vertical trade? Bill, I'm not sure what you mean. I think I am accepting and trading the recommended options play spread. That's the goal of this, is to show you how you can type in any symbol and instantly see a spread that's already optimized for you based on the parameters that we've talked about here of buying a 50 to 60 delta call and selling roughly a 10 to 20 delta call against that. That's exactly the spread that we're optimizing for you here. How do you feel about CS that are based on your DS? Credit spreads? How do you feel about credit spreads that are based on your debit spreads, which have a higher probability of profit and options play score? That's a good question. And the question is really, if I'm trading this debit spread, would I ever consider trading this instead as a credit spread? And I'll tell you why I generally will never do that. So let me set this up. So here is the debit spread. Here's the credit spread. Right off the bat, you can see that the options play score on the debit spread is better. So right off the bat, I'm going to trade the debit spread versus the credit spread, because for the exact same spread, I have the least amount of risk for the better risk to reward. But the reason that I would never trade this as a credit spread, even if it had slightly better risk to reward, is because you're shorting a 150 call. So you're selling an in-the-money call, which opens you up for a lot more risk of early assignment that you don't want to pay, that you don't want to deal with when you're selling a credit spread. That's why you always want to trade a debit spread, because you're buying an in-the-money call and you're selling an out-of-the-money call, versus here you're selling away in-the-money call and then you're selling and then you're buying an at-the-money call. That's really why we generally never recommend you to trade one of these debit spreads as a credit spread. Please mention to check liquidity. I took the Pfizer and Cigna, but went a little further out, much more liquidity. I'm not sure how you're gauging your liquidity, but liquidity, generally speaking, has not much to do with which expiration or strike price, because liquidity is a factor of the underlying stock. So it doesn't really matter whether you trade a 2 or 3 month option on Pfizer, they're just as liquid from each other. So Lee, I don't know what metric you're using to try to figure that out, but generally speaking, it doesn't matter which expiration or strike price you trade. Um, Great presentation tool. How do you account for implied volatility in your model? The options play score is accounting for the implied volatility of the trade in order to decide whether a trade is cheap or expensive. So it's built into the options play score. Awesome on new functions on credit spreads, Jay. Yeah, I'm actually quite excited to do the webinar next week on credit spreads. How should the order be entered? One leg at a time or combined? Always as a combined basis. So when you hit the trade button, it tells you enter the following legs into your broker's platform as a single strategy. You never want to leg into this if you don't have to. Always trade this as a combined strategy. When your 50% stop loss gets hit within the first couple of days, do you take it or do you give it some more time? Generally speaking, it's best practice to take it. Doesn't matter whether it happens a second after you get into a trade or a week or a month. You generally want to stick to your risk management rules regardless of time. Would it ever make sense to enter both a credit spread and a debit spread at earnings time? That way you would be covering whichever direction the stock moved based on its earning report, or is there another way to place stock at earnings report? So John, we just did a webinar last week on earnings, so I highly recommend you to take a look at that webinar. I think we cover it pretty well in that webinar. Buying with 25 to 40 days till expiration, how close to expiration should I hold if I think it will still move? How close to expiration should I hold if I think it will still move? In theory, you can hold on to it till expiration. It's just generally not held to expiration. If you do find that you think the stock's going to continue moving, there's no reason that you can't hold on to it. I'm just saying as a general, you don't hold these till expiration. Where do we see delta? Great question. So you can click on this. Let me reset this back to the put option. So you can hit the blue share button, which expands the trade, and then you'll see a button at the bottom that says explain strategies in Greeks. So you can not only see delta, theta, gamma, and vega right here, but you can actually see it in terms of plain English. So we really try to convert the Greeks into plain English for those of you that are new to the Greeks. I was talking about the options liquidity, not the underlying. Yeah, that's what I'm referring to. So I don't know what metrics you're using to determine option liquidity, but option liquidity, again, is a function of the stock liquidity because that's how market makers make a market in the options, is how easy it is to buy or sell the underlying stock. So from a market maker's perspective, it doesn't make a difference to them whether they're making a market in a 2-month option or a 5-month option. They still have to hedge it with Pfizer stock or Cigna stock at the underlying. So for a market maker, a liquidity is not a function of time. It's a matter of how liquid the underlying stock is. So when you say that the later months are more liquid than the front months, that I unfortunately will have to debate that and say that that's not true. Will I get slides? Yes, you will get the slides as part of the recording afterwards. So everyone that's registered here will get the recording with the slides afterwards. I use Tasty Trade for my platform. They have a good tutorial as well. They are also very pro education. On their debit spread best practice, they suggest a 60 delta, 40 delta is best practice. Just curious on your thoughts. Does that mean buying a 60 delta and selling a 40 delta? If that's the case, then I certainly don't know what, let's just go through an example of that, right? I don't think that that's a good trade because you're basically buying, let's say, a 172.5 put and selling a 167.5 put. So that's what your 60-40 delta put op looks like. So what you have is a very narrow range where you can make money. Basically, you lose money up to a certain point, at around 172.5. You make money if it goes down to 167.5. But if it keeps going lower, you're capped your profits. That's why we always sell a 15 delta call, is because you want to make sure that you capture a move. What's the point of trading a debit spread if you can't capture that move? So that's my thoughts on a 60-40. I certainly maybe understand maybe a 60-30 or a 60-20, but I don't really understand a 60-40. And here's the thing is that you can always set up a 60-40 next to a 60-15 or 60-20 and see what it looks like. And the thing is that you never know until you put the two side by side. Let's say you put the 60-40 next to the 60-20 that we're talking about. see where you think the stock's going to go and see which one gives you the better return. You know, if you think it's going to go down to 155, would you rather make a 28% return, or would you rather make a 146% return? I'm not telling you this one's best because I don't know what your outlook on the stock is. So that's why put in your own strategies, put in your outlook, and see which one's best. When can we register for the credit spread webinar next week? So in the recording email that I send out today, I'll include a registration link for the credit spread next week. Great presentation, lots of learning. Thank you so much. I really appreciate this. Did you already cover how much the tool costs? The tool itself is $50 a month or $500 a year after your initial 30-day trial. So that is the cost. Will I get the slides? Absolutely. Everyone that's registered for this webinar will receive the slides. So with that, that concludes what I have time for here today. I want to thank everyone for taking the time out this afternoon. I hope you guys found this useful in giving you examples and showing you how to utilize and maximize this platform. With that, what I'll do is I'll turn this over for, what I'll do is I'm going to sign off for now. I'll send everyone the link to the recording and webinars and the slides, and I will see everyone next week. Thank you, everyone, and have a great afternoon.